Hello, everyone. This is Adam Koch, President and Portfolio Manager at Libertas Wealth Management Group in Columbus, Ohio, and I'd like to formally welcome you to the beginning of the second quarter of 2018. As always, we do this scouting report about every quarter. Sometimes it's called the halftime report if it's in July, halfway through the year, and then obviously at the beginning of the year we'll call it the market outlook presentation to kind of talk about the year to come. But this time it's beginning of the second quarter 2018, so what we're going to do is we're going to talk a little bit about the stock market, just a little bit about the bond market, and certain levels and things that I'm watching when it comes to the markets, and what the next quarter might look like or what the rest of the year might bring. And so let's just go ahead and get started with some housekeeping items. First and foremost, as always, when you go to YouTube or when you're on our webpage, you want to click on the little gear button down here in the bottom right-hand corner. Then you want to click on the quality drop down and make sure that it's set to the highest quality possible. That could be auto, and that might set it to 720p. It could be 1080i. It could be 1080p. But whatever the highest quality is, that's what you want it set at, so that way you can see the charts really, really well. The higher the quality, the easier it is to see the charts and the details that I'm going to show you here in a second. So with that said, without any further ado, let's jump right into the chart. So year to date, this year started out great, kind of like the year ended in 2017. So we had this nice big bump through the beginning of January, and then all of a sudden we had the fastest decline in history for the S&P 500 in the span of time that it took for it to fall. So we have this huge drop from top to bottom. You can see 2870 or so, 2875 on the S&P, all the way down to about 2580-ish. And you can see we got back above that level in February, tapped that same, call it year-to-date break-even level here. This red line represents the break-even level. Got a little bit of a higher high, which was good. You know, what we wanted to do was see the market kind of tap that level again or stop just short of it and then head higher. Well, that didn't happen. At the end of the quarter, we saw it kind of test this low from back in February, and then it kind of started to creep up again a little bit. And at least at the end of the quarter, which would have been last Friday, the market was down about 1.2% year to date or quarter to date. And as I'm recording this here, the market's down Monday as well. So Monday, the first start of the second quarter. So with that all said, I want to point out another little indicator on this chart. This is just a very, very simple 50-day moving average. 50-day moving average just simply means it's the 50-day trend. So it's the trend of the S&P 500 over the last 50 days. It's kind of smooth, you can see here. And then this blue line down here is the 200-day moving average. So it's the average movement of the S&P 500 over 200 days. What we want to see is a couple things. First of all, we want to see this blue line sloping up. In a perfect world, we'd like to see the red line sloping up as well. So for the shorter to intermediate term trends to be pointing up. In this case, it's sloping down, but third, we want to see the red line above the blue line. So you can see how it's kind of starting to arc down here. It's not very often that we see the 50-day moving average cross below the 200-day moving average. And it's widely called in the media, they'll call it the death cross, for instance. So we don't want to see that happen. That would definitely indicate problems in the market from the standpoint of the longer-term trend. And then last but not least, the black line, which obviously represents the price of the S&P 500 here, we want to see that black line staying above the 200-day moving average. There's a lot of algorithmic trading systems that will use that blue line. So if the market closes below it, you'll see some more selling, which will push the market even further down. There are other systems that will use where the price, if it stays below that blue line for a day, 2 days, 3 days, that you'll see additional selling, which obviously pushes the price down even lower. So what we want to see is to see this black line, the S&P 500, we want to see it staying above the 200-day. We want to see the 50-day, so this red line staying above the blue line, the 200-day, and we want to see both sloping up. Obviously not the case right now. So we're kind of in a neutral environment. And if I move forward to the death cross here back in 2007, so you can see I circled it in advance. We've got this red line again crossing below the blue line, and then you can see how that 50-day moving average, it tried to come back above the blue line, the 200-day, and failed, and it just kind of continued down over the next 18 months. So from top to bottom, 18 months during the Great Recession, 2007, 8, and 9, the market you can see was down about 57, 58% here. So these death crosses are something we definitely want to pay attention to. It doesn't mean we want to go throwing all of our stocks to the curb per se, but we want to pay attention to it. We want to use it as a warning sign, and it's a pretty big warning sign. More of a less of a warning sign, but still a warning sign nonetheless, is again, if the price or the black line here, the S&P 500, if it crosses below that 200-day moving average, that's something else we want to be paying attention to, again, because there's a lot of people out there that use that line as a metaphorical floor below their feet. And if it crosses below that, many times we'll see the market kind of start to accelerate to the downside. So again, we want to be one of the first to leave the party, or at least the fire drill, not one of the last. If we look forward here in time, this was the 2015 and 16, probably one of the toughest markets to manage money in, at least in my career for sure. And you can see here again, we've got a rising 200-day moving average, we've got a rising 50-day trend, 50-day moving average, and then price. S&P falls below both of those lines, so that's obviously kind of a warning sign, but manages to find itself right back up again. Then all of a sudden, it kind of starts to peak here in late spring, early summer of 2015. And then not only does price cross below the 200-day moving average, but you see we get a death cross. Not one death cross, but two death crosses. So this is what we call a whipsaw. A whipsaw is when you sell on the way down the hill in an attempt to avoid a crash, and then all of a sudden you end up having to buy higher than you sold because price started resuming an uptrend. It's not very often. In fact, it's very rare to see two of these happen right next to each other. In fact, I think you have to go back a couple decades before you'd see another one of these in the past. But you see, we got a sell signal here, big time long-term sell signal, another one, and then we've got lower lows. That's the kind of thing we want to be looking out for when it comes to potential market crashes, and especially considering the fact that we are in a really, really long bull market here with no big, huge crash like we've seen in 2007, 8, 9, or the dot-com bubble, or the 73, 74 crash. I think it's important that we're staying on top of our toes. So that's not what we've seen yet. If I go back to that first chart again, we have not seen a death cross. We've just seen prices peaking below that 200-day moving average before the end of the quarter, and then a little bit here to start the beginning of the second quarter. Another thing I want to show you, I put this chart on a couple of the market commentary in the blog that we write, our market commentary in previous videos. This is just simply a 21-day trend, so it's a 1-month trend, this dotted line in the middle here, over the top of the S&P 500, and then the blue line and the red line are 3% envelopes, and all that simply means is that the blue line is 3% above the 1-month trend, and the red line is 3% below the 1-month trend, but that's it. What we typically see, though, is we typically see price, in other words, the market staying between those two lines about 95% of the time. It's not often that you see the S&P 500, the stock market, we'll just call it, break below or above those lines. But you can see here, back in 2015, we had it break below it twice, and then it rebounded quickly. Then here again, 2016 broke below it here once, twice again, and then rebounded pretty quickly. And then we have the Brexit here in June of 2016, and then it rebounded relatively quickly. Kind of went sideways downward into the election, 2016 election, and then since then, kind of for the most part, stayed above, or I should say, in between these 2-3% cushions on either side of the 1-month trend. You might be able to see here in late 2016, there was a little peak above this blue line here, but generally speaking, we spend most of our time, the market spends most of its time in between those 2-3% bands. Now recently, again, what we're seeing is a dip below and a second dip below once again. The question is now, are we going to see another rebound out of the bottom of these bands, or could we see another double dip? Very rare, again, so not likely. Or will we just see it continue downwards? So there's three things that could happen here. It could come back out of this thing. We could see a resumption of the long-term uptrend. The second thing that could happen is it could come up and then head back down again, and we could see another double dip like we saw back in 2015-16. Hopefully not. And then the third thing, of course, would be for it to continue downward, turning the intermediate and long-term trends into a bear market, a down market, which we obviously don't want to see. If that's what we do see, then obviously we need to start taking measures to protect our money and avoid what could turn into a market crash. Moving forward, another one of the things that I like to watch when I determine whether or not I think we're in a bull market or a bear market, or if I think that there's potentially danger ahead, is something called the advanced decline line. So the line you're seeing on top here is just the stock market since last summer, so nothing different than what we've seen before. If I go back to this line this year, it's the same thing. So we're looking at from here right in July to the end of the year, but we're just looking at a different chart. At the top here, this is the S&P 500, so stay with me for a second as I explain this, but the S&P 500 is 505 pretty widely known stocks in the United States. Now, it also includes some small stocks, some micro caps, some small caps, some mid caps, so mid-sized company stocks, small company stocks that nobody's ever heard of. Now, what most people don't understand is that the S&P 500's price, or the value that it's given every day when the market opens and closes, is based on the total price of the stocks on the S&P. Now, what that means is that the biggest stocks get more weight than the smallest stocks. In fact, when you compare a huge stock like Microsoft or Apple or Amazon to a stock, a really, really tiny microcap stock, you might not even know the microcap exists. For instance, a microcap stock could go down 30% in one day, and you'd never see it reflect in the price of the S&P 500 because it's so small. So for that reason, one of the phrases that's used in our industry a lot is that we look at the S&P 500 as being the generals. So think of the leaders in the army, so to speak, or the leaders of a platoon. So they're kind of the generals, the S&P 500, the NASDAQ, the Dow, big, huge price-weighted indices. And then what we see down here, the advanced decline line, we like to call these the troops or the soldiers. So you can't see as many of them because there's so many soldiers, and think of them like stocks. So there's so many microcaps, small company stocks, mid company stocks. And again, because we can't really see them on the price of the S&P 500, what we have to do is we can look at the number of advancing stocks and the number of declining stocks every single day. And then we just plot that on a chart. And that's what this is here in the bottom pane. So this is a chart that shows the number of advancing stocks versus the number of declining stocks every single day of the year. And instead of looking at the value or the price value, what we're looking at is simply the number of stocks that went up versus the number of stocks that went down. And that's it. So what I want to point out is that we've got the S&P 500, the generals up here. The price went down in February again, bottomed out, went up, kind of created a higher high here, and then tapped this floor of support and hasn't quite gotten down there. But generally speaking, it's kind of hit the same spot here. Now, when you look at the soldiers, so all the small cap stocks, mid cap stocks, they're actually rising. In fact, this high here was a little bit lower, so we saw a higher high in the advanced decline line than we did in price. And that's a good thing. That means that there are more small stocks and mid company stocks participating in the uptrend than is being shown by the S&P 500. And that's a bullish signal that we want to see more and more stocks participating in an uptrend. Obviously, if there are fewer stocks participating, that's not good. So we don't want to see this trend in the AD line or the advanced decline line going down. We want to see it going up, and it is going up. So that's a good thing. I apologize for that being so technical, but hopefully that makes sense. If it doesn't, please email me or give us a phone call, and I'm happy to talk about it. So that kind of concludes just briefly our talk about stocks. Let's just briefly, just one slide here. I want to talk about bonds. One of the things I've been saying for a while now is it's going to be really, really difficult to manage a portfolio of bonds if you're just going to buy and hold them. And it's pretty obvious why here. This chart goes back all the way back to late 2014. And this is the TLT. So this is the 20-year Treasury bond. It's been as high as $130. Gone down to 116, up to 143, down to call it 17, up to 128, we'll call it, down to 117 again, and here we are at about, I think that says 121. So 122, 121. So what I think I'm seeing here in the shorter term or intermediate term is a downtrend with a floor underneath price of bonds. These are longer term bonds, and maybe we tap this this downward trend here before it comes back down and breaks below this level. But obviously, I'm not a trend predictor. I'm a trend follower. I have no idea what bonds are going to do tomorrow or next week, next month. But generally speaking, I think that we want to be really, really careful when we're owning bonds, not to be buying and holding them and just sitting on them and turning a blind eye. As interest rates go up, bond prices go down. Interest rates go down, bond values go up. So interest rates have been going down since the 80s for about 30, 35 years, which is why bonds have done so well. When interest rates start to go up in the long term here, I think what we need to pay attention to is whether or not our bonds are going to start declining as a result. Now, obviously, as rates go up, that helps us with interest, right? So interest pays into our account, which can help to negate the loss of principal as a result of the declining bond value. But in either case, I don't know anybody, at least in my career, 17 years almost now, that I've ever met that says they enjoy losing principal. So I still think we want to watch this. Now, in the lower pane down here, 14-day RSI, this is just a momentum indicator. What we want to see is we want to see generally bullish signals. So when it crosses above 70, and we want it to stay there and not cross below 30. But instead, what we see is just a mishmash. I'm sorry, easy for me to say. Kind of just a mess in general. We've got bullish, we've got bearish, we've got bullish, we've got bearish. So I don't know that there's any strong opinion here, bullish or bearish. Again, the intermediate to short term looks down to me. And again, we've got this kind of floor of support here where if the TLT were to break below 115 and hold there for a few days, I think we want to be really, really careful. Anybody would want to be really careful about whether or not they want to hold on, to long-term treasuries, long-term corporate bonds, things of that nature. So just be on the lookout for that. All right, this has already taken longer than I wanted it to, so let's just kind of talk about what I see here in the market going forward. Again, I'm not projecting, I'm not predicting, I'm just guessing on giving you options. So first and foremost, in the short term, we need to see a higher high. So this high that was created in March, we need the market to get above this downward trend line here, the short-term downward trend line, and for it to break above here and start to see a higher high above 2780, 2800 on the S&P. Even better would be see a higher high at 2880 and higher. That'd put us back in a long-term uptrend, which would obviously be a good thing. What is probably more likely to happen is to see it kind of break down and test this floor right here that's already been tested twice again. And obviously we don't want to see it break down below that level, because not only would it break a pretty serious level of support from February and March, but it also, you can see some support and resistance back here in early November, but late 2017. We don't want to see it go back down below that level, ideally. We want to see it staying in this descending triangle and breaking out to the upside. The problem is in the case of descending triangles, unfortunately, the probabilities are pretty high that it breaks down from here, not up. So something we definitely need to watch. Again, the red line, so the 50-day moving average is trading above the 200. We haven't spent a lot of time, and the market has not spent a lot of time below this 200-day moving average, so that's good. So we still have some space here. We still have some cushion. And then momentum on the S&P 500 has not gotten bearish yet. You could say that you could argue that here in February it peaked below 30 on RSI 14, and that would be bearish. But at least so far in March here, we saw it tap that 30 line and then head back up again. So we want to see that stay north of 30. Long term, so we're not there yet, and this would take a few months to actually show its face, but price momentum oscillator is one of the many momentum indicators that you can use to see changes in momentum and crossovers. So this is a negative crossover, so there's a sell signal because the black line crossed below the red line. Here's a positive crossover, so a buy signal right there in the blue line. Here it tries to cross down, but it doesn't, so there's a head fake. And then we get our sell signal right here, 2007, 2008, then crosses back northward again. So here's a buy signal when it crosses over. There's your blue arrow. Then it kind of tries to arc down. It tries to arc down again and fails, but stays positive until again, here we are right below, call it 2015. So in 2015, before that 20-month, call it 2-year sideways downward movement in the S&P 500, we saw a sell signal there and then a buy signal again there. So what we're seeing right now, again, this is a very long-term indicator, so it's not something that you move quickly on, but it's just good for kind of looking at the weight of the evidence, is we're starting to see this thing arc down again, and we'll just kind of have to see what happens over the next several months. But I'm a little bit more interested in the next several days and weeks than I am in months anyhow, but I just wanted to show because I think, again, this is good information. If we step forward one more time here, one more slide, I want to show you this about the market this year in general. Stock Trader's Almanac puts together some great charts like the one we're seeing here. This is the S&P 500 average returns during a midterm election year. So these are seasonal patterns, and you can see a post-election year up here on top in black, then the midterm election year, pre-election year, and election year. So the midterm year right down here tends to be weak to start the year, kind of resumes an uptrend all the way through May, and then from May, call it end of April, beginning of May, tends to be weak all the way until about October, at which point we see a big boost leading up to the midterm elections and then through the end of the year. This line right here is the 2018 line. I finished it just to kind of show you where we are right now. Again, kind of touching these February lows. So performing a lot more volatilely. Is that a word? Volatilely? If not, I just made it up. But a lot more volatility we're seeing this year than we've seen, and obviously in the averages, but that's natural to see more volatility anyhow, especially after a year like 2017 where the volatility was historically low. So hopefully what we see here is kind of a nice little bounce into May, and then hopefully we can get a little bit more of what we can expect. But again, these are all just probabilities and numbers that we can use to create a weighted the evidence approach for determining what to do with our money, and nothing more. So in closing, I think that we could see some more volatility. I'm hoping that we'll see kind of a bounce here into May. But I do think it's entirely possible that we break below those February low levels and stay there for a few days, which could cause additional selling, at which point we want to be a whole lot more conservative with our money. We might want to raise some cash. We might want to step aside and put our metaphorical players in the locker room. If the storm gets too bad, we don't want our investments getting hit by lightning. But we just have to see what happens. We're not going to try and predict the market. Anticipating the trend is never a good idea. Following the trend is. So if you have any questions at all, please give me a call, shoot me an email. Our email address, our company email address is right there on your screen. If you want to look us up on the web, check out our website. Feel free to follow us on Twitter, either the company or myself, and on Facebook. So any questions, let me know. Please feel free to let us know if you'd like a second opinion on your portfolio, your retirement plan. We'd be happy to do so. But otherwise, thank you for watching, and we'll look forward to seeing you next quarter.